Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your December 2019 market update. Well, 2019 turned out to be a stellar year for both the stock and the bond markets. As you can see on this chart, the three main stock market indices that I show you each month were up more than 20%, with domestic large cap stocks, which are the largest 500 companies in the United States, leading the charge. Smaller companies had returns of 25.52%, and the stocks of companies domiciled abroad were up 21.51%. Investment grade bonds, which are bonds with a low risk of default, had their best return in 17 years, up 8.72%. And even the broad commodities asset class, which includes sectors such as gold and wheat and oil, was up for the year with a return of 7.69%. Looking back on 2019, we can break the year into three phases. So phase one was the recovery from the dismal fourth quarter of 2018. If you've been invested for a few years, you'll likely recall the sell-off that occurred in the fourth quarter of 2018. And this gave us a very low starting point for the equity markets heading into 2019. The first 4 months of 2019 started off with a very sharp recovery from the downdraft of 2018, which is shown by that yellow line there. And by the end of April, the market was up over 18%, and we were back at the previous highs established in September of 2018. So for newer clients, it's really important to remember when looking at those returns that I just showed you on the previous slide, that over half of the return in 2019 came from the first 4 months of the year. So if your account was invested slowly over time by your direction, or if you didn't have money with us until sometime after the first quarter, quite a bit of the return for the year was already made before we invested your account. So just keep that in mind as we get the fourth quarter performance reports out to everyone. So we had a really nice increase from January through April back to previous highs for the first couple of months of 2019. From there, we enter phase two, which is really sideways choppiness in the markets as investors began to worry about a recession. The trade deal with China heated up, and that in itself led to quite a bit of the volatility in the markets because increased tariffs, which is what was announced during the summer months, increased tariffs have three major effects on the economy. So first, tariffs weaken corporate earnings because when tariffs increase, input costs for those companies increase. And as an owner of a common stock, you actually have a claim on a company's earnings. And when you buy a stock, you're actually purchasing a proportional share of the entire future stream of earnings for that company. So if earnings are expected to weaken due to increased tariffs, the stock may not be worth as much, and so the price adjusts accordingly. So that led to some of the choppiness during those summer months. Another reason why the trade war led to some choppiness is that the tariffs were on mostly consumer goods, and consumer spending accounts for approximately 70% of the US economy. If people spend less, our economy slows, and this increases the chance for a recession. And thirdly, tariffs can also lead to a slowdown in hiring. And this point's really related to that last one, in that a good jobs market keeps the consumer healthy and spending money, which in turn stimulates the economy. And so the announcements during the summer months of increased tariffs as the trade war escalated with China really took some investors by surprise and caused investors to take some profits and sell after quite the nice run up in the 4 months of the year. And that led to a bit of a sideways market for the middle third of the year. And then finally, we entered what we'll say is the year-end rally because the US and China reached a partial trade deal, which is expected to be signed on January 15th. So under this pact, Washington agreed to cancel some new tariffs and reduce rates for other duties. And China said it would buy more US agricultural products. And it also included changes related to intellectual property and technology. And additionally, Britain moved closer to leaving the European Union in an orderly fashion, which decreased some other risks that have been hanging over the markets for quite some time. So we had this really nice year-end rally after quite the pause and sideways move over the summer months. And the return was probably much more than most expected. But that was just the equity markets. The fixed income markets or bond markets rallied as well. It was a monumental year for fixed income, fueled by the relentless US-China trade war. Concerns about the health of the global economy sent bonds around the world surging. At one point, $17 trillion worth of global bonds were trading at yields below zero. Remember, as yields go down, bond prices go up. So as the interest rates decreased, the Fed lowered interest rates and rates around the world continued to decrease. Bond prices went up, leading to this massive rally in bonds and the best return for the investment grade domestic bond index since 2002. Bonds did move sideways for the last 4 months of the year, but we were able to hang on to those gains so far. So I want to put this all together for you to show you really the power of diversification here. This chart shows the asset class returns for each year going back to 2005, and the asset class that had the best return is shown in the top row, and the one with the worst return is shown in the bottom row. And what I want to point out here is what a difference one year can make. In 2018, you see the top performing asset class was cash at 1.8%. And in 2018, it was really a dismal year for investors. Cash was the only major asset class that even earned a positive return. Even the bond index earned a return of about zero, and all other major asset classes had a negative return for 2018. So while cash was the winner in 2018 and 2019, you saw quite the reversal there. Cash was the worst performing asset class, and domestic stocks were the best performing asset class. And what this chart is really supposed to show you here is if you look at that white box in the middle that's connected by the black line, that shows a properly diversified portfolio and the returns if you combine all the asset classes. And what you can see is by remaining diversified year after year and owning a wide range of these asset classes in different percentages, which we do for you as part of the investment process, you're able to get more consistent returns over time. And the key here is with less volatility. That column on the far right is volatility or risk of your particular investment. And so what this is showing is a properly diversified portfolio had experienced consistent returns while taking on less risk than almost all of the major asset classes. So very important to stay diversified. Just because cash worked well last year did not mean at all that cash was the investment to be in 2019. And so that's why we maintain a diversified portfolio for you. So what do we see looking ahead after such a big year in 2019? Well, right now, I will say that we could use a small pullback in the markets, or at least a pause that refreshes given the current readings on the equity indices and what things are looking like there. We might be getting that now as the markets are pulling back today when I'm recording this due to some issues with Iran and some Middle East tensions heating up. So a small pullback at this juncture, very short term, would be very healthy for the markets. It's something that needs to happen so that we can take another leg forward. Looking longer term though, over the course of 2020 and in the years ahead, we do see that while the global economy remains weak, the US still looks more likely to experience slow growth than a recession. And this is important because the stock market declines that are accompanied by a recession tend to be deeper in magnitude and take longer to recover from than those that are not accompanied by a recession. So as such, we assess the probability of recession occurring very closely. And right now, given the data and different economic surveys that are coming in, I really think the probability of recession occurring in 2020 is somewhere around 25%. So still quite low. Additionally, in 2020, we do think that trade issues and the contentious political environment are likely to remain in the headlines and cause bouts of volatility, especially given that 2020 is an election year. And one of the sectors this could really affect is healthcare, given how the Democrats are running versus how the Republican ticket is running for the presidential reelection. So that's something we'll be watching closely. And after the recent run-up in stocks, current valuations and economic fundamentals suggest lower investment returns going forward. while stock prices can still climb higher from here, we don't expect results in 2020 to be near what we experienced in 2019. But that being said, active management is very important as we get later in the cycle, and we are still finding plenty of investment opportunities. We just need the market to take some time to consolidate a bit and to refresh itself after the recent run up. We can buy up some additional investment opportunities, and hopefully we'll continue to go up from there. We wish you the best in 2020. We thank you for your continued confidence, and please reach out to us with any questions that you may have.